Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm Professor Code and this is the Forex Super Model weekly review for Monday the 8th of November to Friday the 12th of November 2021. Basically, we've written up the weekly flows just to get us underway for the period then. So euro dollar minus 112. So over that period, the 8th to the 12th, the last trading week, the euro dollar as an FX pair lost 112 points or pips. Euro yen minus 74, euro pound minus 45, pound dollar minus 60, pound yen minus 4, and the dollar yen plus 52. If you plug that into the model formula, then you get a negative opposed driver in the euro minus 231, front and back door flows mainly going into the dollar at plus 224, into the yen at plus 26, and the pound is the negative rocket minus 19, activity plus or minus 250. So over the week then we've had a soft euro driving the market and forcing positive flows mainly into the dollar and into the yen, and the pound is the negative rock there. They're sort of static in the middle. Now that's not the whole picture because yesterday we had a bit of a sell-off in the dollar. We'll talk about that later. Right, so we'll stop that there and write up the asset classes. Right, we've written up the asset classes then. So US dollar index basically it's done a break of the resistance, and it's plus 0.2. So it's 20% above the resistance break, if you like. So it's come back a bit yesterday, but nevertheless it's still 20% above the resistance break. Gold, normally it wouldn't like a strong dollar, but we're getting an inflation effect in gold where it's a hedge against inflation, and gold has been pumping up and it's 0.18 from the high, 18% from the high. Oil did this break. It basically broke about 40% from the resistance, and it's come back about 0.22, so it's come back 22% from the high. Wall Street, S&P Tech, they've all got the same look. They've done a break, they hit new highs, and they've come back slightly. 0.11 from the high, Wall Street, 0.10 from the high for S&P, and 0.11 from the high from the tech. So basically we've got 10% pullback on the equities, but they came up yesterday late. So US 10-year in the bund, this is the price. So we had this pump down in price, rising yields, then we had this bounce. The US 10-year is 0.22 from the floor, so it's 22% above the model floor, well below half marks, yields relatively strong. And the bund, on the other hand, is 0.33 from the high, so it's well above half marks, yields relatively weak. So there's a significant yield differential between the US and the EU. So that's something to bear in mind. Copper's been chopping about, it's not 0.45 from the high, so it's above half marks just. And US steel is similar, 0.40 from the high, so 40% below the modelled high. So what's been knocking about, or going to knock it about? Well, Monday, the 15th, which is the first day of the new trading week, we've got China retail sales. That's sort of Sunday, early Monday morning. China retail sales, and we've got RBA minutes coming through early next week. Euro GDP, US retail sales, and Wednesday we've got GBP CPI and Bank of Canada CPI. So we've got inflation data and a bit of GDP data and retail sales. So we've got a good mix there of tier one data, and we'll talk about the rest of it in a bit. So we'll stop that there, write up the data cycle, which is our version of the economic calendar, and then move on to the final analysis. Right, we've written up the data cycle, and some China's neutral to positive. The dollar tier 1 is mildly positive, at tier 2 much better positive. German tier 1 neutral, tier 2 negative. Euro neutral, yen neutral, pound neutral to negative, CAD neutral to positive, AUD tier 1 negative, tier 2 slightly positive, NZD positive, and the Swiss neutral to positive. So so the key thing here is we've got nobody sort of poking their head up or down particularly strongly in the data cycle, but the dollar's certainly hanging in there on the strength on the data to a certain degree, despite this Michigan consumer sentiment yesterday. But it's no great shakes, and the key takeaway is all this neutrality in the data. So the data cycle isn't really driving the FX market in a strict sense. So let's remind ourselves what was happening then. So the flows then for the week, we had this weak euro as the opposed driver, driving positive flows into the dollar, and the yen and the pound relatively static. Now Friday, as an FX day on its own, you had the pound driving yesterday at plus 111. Front and back door flows mainly coming out the euro, out the dollar, and the yen was slightly positive. So you had a bit of pound strength yesterday on Friday, and overall the pound has been the negative rock, so it's come back a bit, but it's still a little bit soft. And if you look at last week, just to remind yourself or ourselves, last week it was all about pound weakness. The pound was the negative unopposed driver last week to the tune of minus 615 points, driving positive flows. Remember, the pound was ramming these positive flows into the yen, into the dollar, and to a less extent the euro. So we had pound weakness last week, and we've got euro weakness this week driving. Right, so let's just grab this and talk about what we think might happen. So you've got the dollar, the euro, the yen, and the pound, the CAD, the AUD, the NZD, and the Swiss. Now, as we say, the data cycle is predominantly neutral. No great shakes. We've had this Michigan consumer sentiment, which, and if you looked at our video for Friday, for the daily briefing early Friday, we basically said we thought that the USD had peaked due to the style of the flows that were coming out of the Asian session, and previously on the Thursday and the weekly flows. That whole picture suggested a peak in the USD, and during the morning session it didn't really happen. And then you got this catalyst which gave the market excuse to sell off the dollar, which was this quite poor Michigan consumer sentiment. And you've also got the administration, Biden's crew, saying that they're unhappy about high inflation, even though arguably they're the ones that have caused it through massive printing. But that's a separate issue. But anyway, so they're unhappy about it because people are dripping about it, and they've lost a recent election as well. And they're worried about the midterms, but that's political, but it does have a bearing on FX. Right, so what have we got then? We've got this strong dollar which has come off on Friday, so it's hockey sticked a bit, but it's still pretty strong. You've got gold, which is basically on the up, and people are running into gold now for the basis of this hedge against inflation, and we're coming into the sort of the gold buying season, which is the sort of Christmas period, etc., New Year. So that's an issue as well. Oil's come off a little bit, but it's still pretty high, and that feeds into the imported inflation, and so on. So and now the equities are sort of about 10% off their highs. So the equities are high, and the yen is starting to see weakness in the usual transmission. AUD has been weak off the back of poor employment data earlier in the week, and we thought the AUD might bounce. It had a very moderate bounce. We suggested looking at AUD USD long, and it did sort of do it, but it was choppy. But anyway, that's another side issue. So what do we think is going to happen next week? Well, what have we got? We've got retail sales, we've got GBP data, US retail sales, and CPI. So we've got inflation and retail sales, so quite strong indicators of the health of major economies. So the key for us is we've still got this significant yield differential between the US and Europe, EUR. So it's likely the dollar's not done yet until we've had this fall off in the dollar on Friday, and therefore we've had this pullback, which if anything is beneficial to commodity FX and equities. So we're likely to see certain things happening next week, and it depends on the Asian flows to be really certain about it or to talk about it. But it looks like we've still got this yield differential, so the dollar's likely to be strong. The euro's been negatively driving. We probably think the sentiment is against the euro, so we think the euro is basically heading into negative territory. And if you're sucking funds out of the euro, and you've got a relatively positive equity transmission, which means a negative yen, then you've got negative coming out the yen as well. And the pound, remember, was heavily sold off last week, which was ramming positive flows into the yen, etc. So the pound's got plenty of elbow room to come up, and the dollar. So we think the dollar's going to be neutral to positive. The euro is going to be negative. The yen is going to be neutral to negative, and the pound is quite likely to cop the bulk of these opposing flows. So that's what we think is going to happen there. So, but obviously, until we see the Asian flows, we're not going to be committing ourselves on that. But that's a likely scenario. Then watch out next week for this sort of scenario. Dollar neutral to positive, euro taking the brunt of the yield differential negativity, yen neutral to negative off the back of probably steady to rising equities, and the pound getting the bulk of the opposite end of this euro weakness. So getting the benefit of the euro weakness, and last week the pound has got plenty of elbow room to come up. So anyway, hopefully that was useful. See you, it won't be tomorrow because it's Sunday. See you Monday for the Monday briefing. So thanks for watching, and goodbye.